We're always taught to think of market crashes as just pure disasters, right? Moments of total panic and loss. But what if that's only half the story? What if these are actually predictable, cyclical events that, if you're prepared, represent one of the greatest wealth creation opportunities in a generation? So that's what we're going to do. We're going to dive into the patterns of history and see how the next big downturn could actually become your biggest opportunity.
And really, this is the core idea. The technology, the companies, the people in charge, yeah, they all change. But the human emotions underneath it all, fear and greed, and the economic cycles they drive, well, they tell a story that's been on repeat for hundreds of years. So look, this isn't about some crystal ball trying to predict the future. It's about learning to recognize a story you've definitely seen before.
And you can literally see this rhythm playing out over time. You get these major corrections, these shakeouts every few decades. We had the big one, 1929, the Great Crash. Then came the dot-com bust in 2001, which just vaporized all those speculative tech companies. And of course, the global financial crisis in 2008. Now, each one was different, sure, but the pattern, an overheated market followed by a sharp, painful correction, is exactly the same. Which kind of leads us to ask, are we getting close to the next echo?
To even begin to understand where we might be heading, we absolutely have to look back. And there is no better case study than the 1929 crash. I mean, it is the blueprint, the original template for nearly every boom and bust cycle that has ever followed. Understanding its anatomy is absolutely crucial to navigating our own time.
Just try to picture the Roaring '20s. It was this incredible decade of jazz, amazing new technology, and just soaring, unstoppable optimism. It really felt like the good times would never, ever end. And everybody was getting into the stock market. I'm talking from the titans of industry all the way down to the factory workers on the assembly line. A lot of them buying stocks on credit, just completely and utterly convinced they couldn't possibly lose.
But underneath all that champagne and celebration, the economic foundations were getting weak. American factories were churning out more goods than people could actually buy. And while corporate profits were going through the roof, wages for the average worker, they weren't keeping up. So how do you bridge that gap? Debt. People and companies were borrowing insane amounts of money to keep up the illusion of prosperity. These were the cracks in the foundation that everybody just chose to ignore.
So, when the market finally did turn in October of 1929, it wasn't just some financial correction. No, it was a psychological break. The crash was so violent and so sudden that it just shattered the public's faith in the entire economic system. The optimism that had defined a whole decade, it evaporated in a matter of days, replaced by pure, raw panic.
So, now that we have a century of hindsight, what was the biggest mistake people made back then? It wasn't just about buying the wrong stocks. It was something way more fundamental, way more human.
It was this, plain and simple. The biggest mistake was the belief that this time is different, this dangerous idea that the market had entered some kind of new era where prices could only go up. This unchecked optimism, this investing based purely on emotion, that's what left millions of people completely exposed when reality finally came crashing down.
So, this is a crucial point. We have to redefine what a crash really is. It's not just an ending, it's also a beginning. Yes, it's a destructive force that wipes out wealth that was built on nothing but speculation and leverage, but it's also a creative one. It's a massive transfer of assets, from the panicked and unprepared to those who stay calm, stay informed, and have a strategy ready to go.
Okay, so that brings us to today. We've looked at the anatomy of the 1929 collapse. Now let's listen closely and see if we can hear the echo of that history in our own time. Are those same warning signs flashing right now?
Well, when you put them side by side, the parallels are pretty striking. Back in the 1920s, you had expanding credit, asset bubbles, and widespread public speculation. Now, fast forward to today. We have record levels of global debt, way beyond what they saw back then. We have ballooning asset prices, not just in tech stocks, but in housing, you name it. And on top of it all, we have unstable inflation, which makes the job of central banks incredibly tricky. The parallels are just hard to ignore.
You know, this famous saying just captures the idea perfectly. Of course, the details are different. We don't have the same industries or technologies as the 1920s, but the underlying pattern, the rhyme of easy money, soaring asset prices, and this widespread belief that the boom will just never end, well, that sounds dangerously familiar, doesn't it?
Okay, so we've laid out the historical precedent and the warning signs we're seeing today. And yeah, that can sound a little alarming, but it doesn't have to be. The point here isn't to be fearful, it's to be prepared. This is where we shift from just analyzing the problem to taking action. How do you actually position yourself to turn potential chaos into a generational opportunity?
So here's a potential playbook. And it's not about trying to perfectly time the market. That's a fool's game. It's about discipline. First step, build liquidity. That's just a fancy way of saying have cash ready. Because when panic hits and everybody is a forced seller, cash isn't just a safe haven, it's a weapon. It gives you the power to buy incredible assets at a massive discount. Second, focus on value. Look for solid companies with real profits and low debt, the kinds of businesses that will still be standing strong in a decade because they solve real-world problems. They're the ones that survive the storm. And third, watch the flow. Where does the smart money move when it gets nervous? Watching capital flow between things like gold, bonds, and energy can tell you way more about real market confidence than the daily headlines ever will.
And never, ever forget that downturns are when the next generation of giants is forged. I mean, think about it. After the dot-com bust in 2001, a resilient Apple went on to basically own the next decade. After the 2008 crisis, a then struggling company called Tesla found its footing and revolutionized the entire auto industry. And from the ashes of that very same crisis, Bitcoin was born. Chaos clears out the old guard and makes way for the new.
So it really all comes down to this. These cycles are going to continue to turn. The events we've talked about, it's not a matter of if, it's just a matter of when. The only real variable in this whole equation is you, and the choice you make and how you decide to prepare for it.
And if you remember one thing, make it this. During the boom years, yeah, it feels like you're getting richer as all your asset prices go up. But real, lasting, generational wealth, it isn't made then. It's captured during the bust. It's seized by buying high-quality assets when everyone else is frantically selling them out of pure fear.
So I'll just leave you with this question. The patterns are there for anyone who's willing to look. The lessons have been written in the collapses of the past. So when the music finally stops and the panic begins, will you be swept away by the emotion of the moment, a victim of fear, or will you have the clarity and the discipline of a student of history? The choice is yours.